Most retirees have been told they just need a simple withdrawal plan, but there's a hidden risk in retirement that most people don't talk about. It's called the $1,000,000 retirement tax trap. If you pull from the wrong account at the wrong time, you could pay hundreds of thousands, if not seven figures plus in taxes, and you need to. And that can potentially slash your retirement timeline by a decade. So how do you build a retirement spending plan that avoids the $1,000,000 tax trap, protects your income, minimizes your taxes, and lasts your entire retirement? Well, that's exactly what I help my clients solve every single day. Because if you're heading into retirement without a clear withdrawal plan, you're not just risking taxes, you're risking your entire timeline. Hi, if you're new here, I'm Eric Rodriguez. I'm a certified financial planner with decades of experience in the industry, helping pre-retirees and retirees protect and grow their wealth with a tax-smart wealth plan. I've helped hundreds of retirees avoid these critical tax traps and build smarter, safer income plans. So in this video today, I'll show you the costly mistake built into most withdrawal strategies, the right order to tap your accounts for long-term success, and how to use a dynamic, tax-aware approach to keep your money working longer, safer, and smarter. So let me ask you this. If you've saved over $1,000,000 for retirement, do you know how much of it you'll actually keep? Because the real threat isn't market crashes or inflation, it's the silent tax drain built into most withdrawal plans. Here's what we've seen. Over a 30-year retirement, poor withdrawal sequencing can cost retirees between $400,000 and over $1,000,000 in unnecessary taxes and missed compounding. And that's not a guess. That's what the math shows when we run real projections. So think of it as a $1,000,000 swing decision. Sequence your withdrawals wrong and you overpay the IRS. Sequence them right and you keep that money working for you and your family. To give you a specific client example, we once had a client had about $1.3 million spread across an IRA and a Roth IRA and a brokerage account. Their plan was to pull from the IRA while deferring everything else. On the surface, it looked really smart. But when we projected it, that sequence pushed them into higher brackets early. And what that did is it led to ballooning of their required minimum distributions later on in their retirement, and ultimately left them with nearly $978,000 less in retirement value after taxes. They were completely shocked. They had spent 30 years saving carefully, only to realize the way they planned to spend their money could unravel it. They thought delaying taxes was always the best route, but that assumption nearly cost them a third of their retirement. So what we did is we built their strategy using our tax-smart withdrawal framework. So we balanced accounts, filled tax brackets wisely, and converted at the right moments. They walked away with clarity, and more than that, a sense of permission to spend, to enjoy retirement on their terms without worrying about surprise tax bills later. And the result of all this smart planning is with the same starting assets, the same life expectancy, but over $900,000 more in net retirement value. So here's what I see a lot from prospects and even newer clients that come in is most people withdraw based on their habit or convenience. They tap whatever account feels the easiest. And that usually means the pre-tax IRAs or 403Bs or 401Ks. But that choice, just that one choice, could push you into a higher tax bracket, which could trigger Medicare surcharges or stack your income in ways that could cost you thousands. This is a big deal because retirement spending is like peeling from the wrong side of an onion. It looks simple until you dig in. Each layer you peel has hidden tax consequences, and those layers add up quickly. One extra dollar withdrawn in the wrong year could push you into that next tax tier, which could trigger IRMA penalties or raise taxes on your Social Security. So failing to plan your withdrawals isn't a small oversight. It's one of the biggest silent killers of retirement plans. So we're not just talking about paying more in taxes. We're talking about running out of money faster, which is one of the number one concerns retirees have is running out of money. We're also talking about reducing your legacy and limiting your lifestyle unnecessarily. So what we need to do is we need to have a strong framework. So we call this a tax smart withdrawal framework to solve this problem. It's about knowing not just how much to withdraw, but when and where to pull from. So we do this based on your income, your tax bracket, and your future RMD exposure. So in a sense, it treats retirement like a financial jigsaw puzzle where each piece might be placed with foresight. Instead of blindly withdrawing a fixed percentage, we model your income year by year. And what we do is we match it to the most tax efficient withdrawal option. Here's a step-by-step on how we do it. So first off, step one is we're going to map your income sources. So your Social Security, your pensions, all of your investments, because you need a clear picture of what money is coming in and how each source is taxed. Because if you don't understand the layers, you can't coordinate withdrawals effectively. Step two, we want to withdraw from taxable accounts first in most cases. These usually have the least tax impact if managed properly. By doing this, we can then first allow your tax deferred accounts to grow. So we're keeping your adjusted gross income lower in retirement just by doing this. Step three is we're going to use strategic Roth conversions during your low income years. This helps us prepay taxes at a much lower tax rate and potentially shrink your future required minimum distributions. So think of it as a tax sale. You're buying out the IRS while prices are low. Step four, you want to delay pre-tax IRA or 401k or 403b, any pre-tax accounts you have. You want to delay those withdrawals strategically. We take controlled withdrawals or convert portions as needed. So rather than wait for forced distributions, what this is going to do, it's going to keep your income curve smooth and prevent income spikes that can trigger IRMA and high tax brackets. The next step is we're going to stay inside a target tax bracket. So we use bracket filling to keep your income optimized and avoid surprise penalties. So for example, if your marginal bracket ends at $94,300, we fill up to that line, not a dollar more. So every withdrawal works for you, not against you. Let me explain why this works. Most strategies only focus on this year's taxes. Ours at my firm WealthBuilders, we look at your entire retirement timeline. So it's a very proactive approach, not a reactive approach. And that's how you should approach this type of withdrawal and tax planning, because you want something that's going to adapt every year as your life changes. So think of it just like navigation. You don't just set a destination and drive, which oftentimes we do, but sometimes you're going to have to reroute as needed. The tax smart withdrawal framework does the same for your retirement withdrawals. And this isn't just about tax savings. It's also about gaining peace of mind, taking those trips you've dreamed of, helping your children while you're alive, and giving without guilt or any hesitation. This strategy gives you permission to live, not cautiously, but confidently, to say yes to new experiences, big milestones, and lasting generosity. So if you've saved over $1 million for retirement, congratulations, that's amazing. But the decisions you make about when and where to withdraw could be the difference between maximizing your lifestyle or watching unnecessary taxes quietly erode your future. And I always say, if you don't have to give Uncle Sam a tip, please don't. Click the link below to get a personalized breakdown of your retirement income strategy. We'll show you exactly how long your money will last, where hidden tax risks are lurking, and how to make your withdrawals work smarter, not harder. So this isn't just a tax plan, it's a confidence plan. So it's one that helps you spend wisely, avoid regret, and make the most of every dollar you've worked so hard to save. You don't need to guess your way through retirement. With the right structure and sequencing, you can make your money last longer, pay less in taxes, and retire with clarity and confidence. Once again, thanks again for watching. If you want some more information, go ahead and click the link below in the bio, and I'll see you in the next video.